Hello traders, this is John Kickletter, Chief Strategist for DailyFX.com, here with the Forex strategy video inspired by the RB&Z rate decision that we had earlier today. Now, this particular rate decision really highlights a particular lethargy in the market. We're really not moving on one of the most important themes that we have, and that is relative monetary policy. The RB&Z surprised the market, and not necessarily the move. It didn't move. It actually held its benchmark lending rate at 2.5%. However, the forecast that was given by the governor himself, Wheeler, suggests that he is going to tighten monetary policy over the next 2.5 years over 2 full percentage points. That is a massive increase, and more importantly, it's a huge contrast for most of the central banks amongst the majors, which gives the New Zealand dollar a substantial yield advantage. All right. This highlights a growing inequity between the yield on some of these really well-positioned currencies, particularly the New Zealand dollar, which stands out, and counterparts like the Japanese yen, who are leaning towards more stimulus. This divergence is a perfect forward-looking expectation of return, and in turn, that also is where we see capital flows are encouraged to shift from one currency or region to another. That is, in other words, the foundation, typically, of major trend development. This particular theme, as well as risk trends, typically jostle for position and influence over the market. Yet, we can see that with this past session, while we did have a notable pickup in the New Zealand dollar, we saw it with the Kiwi USD, saw it with the Kiwi Yen recovering some of this lost ground, and the Aussie Kiwi dropping to a new 5-year low. We see the impact, but where is the follow-through? I can't stress how significant a essentially a 2.25 percentage point increase over that time frame is when you compare it to its counterparts. All right, it is dramatically different. The New Zealand dollar is at this point at the very end of the high yield curve, and it is looking like it is at the even further extreme for expectations. All right. Now, the New Zealand dollar is perhaps one of the best positioned for a high-yield forecast. The Japanese yen, no doubt the worst outlook for monetary policy. All right, this competitive monetary policy scheme sees the Bank of Japan leaning towards a near-term increase to its open-ended stimulus program. The market is heavily expecting that before the April rate or tax increase, that we will have an expansion of the open-ended stimulus program. But you have seen limited traction on that theme, though the yen crosses in general have certainly benefited in the lead up to the speculative expectations. It has not necessarily, however, covered the same kind of ground that we had in the initial run-up to the first round stimulus program, which we can see here illustrated by this blue box on the dollar-yen and the lack of follow-through on the post-announcement of that program after April. All right. We do have the follow-through, or the pickup of an activity, but as you can see, apples to apples, we are not getting the same kind of momentum on this increasingly divergent theme. All right. If this were the same condition, if we were in the same point last year, and we had a RB&Z vow of 2.25 percentage points increase in benchmark rates, and we had the Bank of Japan leading up to its expansion of stimulus, we would have probably seen the Kiwi yen significantly higher than where it is now. But as you can see, to this point, we've still not overtaken this April swing high. That's pretty remarkable. All right. And of course, everything else fits between this extreme. The yen on the most dovish, the Kiwi on the most hawkish. We can look at the U.S., where the Fed is contemplating a taper, and expectations have started to move towards the possibility of a December taper. Right, this is what this blue line represents, expectations of a December taper, where previously they were looking all the way out till March. All right, in late October, early November. That is moving forward. This puts the U.S. dollar on the hawkish side of the scale. We have the euro all right, which is expected to come into a new stimulus program sometime in the first half by the end of the first half of 2014. That puts them in the dovish column. Yet you compare a taper candidate to a new LTRO candidate, the stimulus program, preferred stimulus program in the Eurozone, and you see exactly the opposite of those expectations. Your USD continues to buoy. All right, this is a reflection that the market is not paying its due respect to this particular theme, right? Relative monetary policy, which is the return aspect of risk reward, or the reward aspect. This is a very important theme. This is, without doubt, I would say the second most important thing of all of investing. The first is going to be risk, fear, panic. Right? Panic has a much greater influence when it does pick up than greed does. So the risk element is always going to be the most critical, most market moving. But the return is a close second, and it works in conjunction. So what are we seeing? Why is the dollar not rising because of taper expectations? Why is the euro not dropping, considering that it is likely heading into the first quarter of next year with the stimulus pickup? Why is the British pound so buoyant, knowing that its rate hike, although it has been moving forward, is still out in 2015 or mid-2015? And why is the Kiwi, who is quite clearly facing a very hawkish central bank, not rising more aggressively against the Bank of Japan, which is contemplating its second massive open-ended stimulus program? All right. This is a reflection of a particular theme that we have seen playing out very nicely, very consistently in the S&P 500. That's why I keep referring back to it. We'll always refer back to this particular benchmark. It's a reflection of risk trends. All right? There is a very serious level of complacency in these markets where we see investors have become so comfortable with the prevailing themes of leverage and the reach for return that they are keeping status quo. Now that reach for return has not been equally shared, however, with the FX market. That's why we have seen quite a significant deviation between the S&P 500, a risk benchmark for general financial markets or capital markets, and the carry trade index as we have here, the Deutsche Bank Carry Harvest Index, which is a risk measure of the FX world. That comparison and this correlation go back a long way, yet we have seen a very substantial deviation here. This is perhaps a sign that we will have a meaningful move towards risk. It can't be that the carry trade aspect is going to catch up to general risk trends, or that the excessive premium in benchmarks like this, the the religious leader of the financial markets, the S&P 500, who is buoyed by the moral hazard of the central banks of the world, maybe that is going to start to come back down. All right, but it's likely that this, or it's inevitable that this deviation is going to be closed. That preoccupation, even though it doesn't seem to be an active driver, it is. Just as we see a very aggressive risk-on move can override any other concern, an aggressive risk-off theme can override any other concern. When risk trends are important, yet they are sidelined, that too can be a very distracting and very market influential theme. And we know that we are looking at risk trends that are very comfortable and very comfortable in the fact that we have a seasonality effect that many people can fall back on, as we see here with this S&P 500 volume and performance chart for the various months. We know that December is a positive leaning day on exceptionally low volume. And the markets can continue to cater to this typical theme, comfortable knowing that this is what happens on average. However, when conditions start to pick up, if risk themes start to move again, if relative stimulus can take over from risk themes because they unmoor, then we are going to start to see some far more dramatic movement based both on risk and appetite for yield, as well as relative monetary policy programs. So keep your eyes on pairs like the Kiwi Yen at the very extreme of the threshold, where one is looking at an aggressive hike, the other one is looking at much more aggressive easing. And you can even compare those that are much closer in the scale. Euro USD, where the Fed is talking about taper, the ECB is talking about a new LTRO program, and you can get even closer when we look at something like the dollar and the pound. Both are talking about the eventual return to rate hikes further down the road, no doubt, but they are in this very close to the same equilibrium point. Nevertheless, once risk trends start to really pick up, once that monetary policy comparison starts to pick up, that's when we're going to have some bigger moves. So we might not have it through the end of this year. There will be a couple of points of contention where you can see this theme might have a few sparks to it, namely next Wednesday when we have the Fed rate decision, but this is no doubt going to be a very important theme come first quarter of 2014. So keep it in mind for your trading, your positioning. We'll do our next Forex strategy video tomorrow. If you have any suggestions, you can always tweet them at me, or you can email them at me at jkicklighter@dailyfx.com. Good luck trading out there, guys, and I'll talk to you once again tomorrow.